The domestic stock market has been going through a period of adjustment recently, with major indices taking a breather. However, paradoxically, the amount of debt being taken on by individual investors to buy stocks, a so-called B2, has hit record highs. Now it seems that retail investors are betting big on a rebound. For a closer look at this phenomenon and the risks involved, our Kim Do-yeon joins me in the studio. Welcome, Do-yeon.
Good to be here.
So, Do-yeon, let's get right to the numbers. You said the debt has hit a record high. Just how big is this loan volume for investment?
Right. First, the scale is quite unprecedented. But first, we know that KOSPI started off in the mid-2000s early this year, and now it's past 4,000 points. So there's been a steep incline, and that's what's really fueling these individual investors to jump into stocks, even at a risky cost of borrowing money. Now, as of November 17th, the total credit balance in the domestic stock market, essentially money borrowed specifically to buy stocks, hit an all-time high of 26.6 trillion won. What's striking is where this money is going to, and it is heavily concentrated in the semiconductor giants as investors bet on a rebound. For SK Hynix, as of the 18th, the margin loan balance surpassed 1.14 trillion won. That is a massive 43% jump compared to just the end of last month. Samsung Electronics is seeing the exact same trend. Its margin loan balance reached 1.438 trillion won, a 41% increase over the same period. And it is not just brokerage loans. People are going to banks to get the cash to invest. Last month, other loans in the banking sector, which includes credit loans often used for investment, spiked by 1.4 trillion won. This is the highest monthly increase we've seen since July 2021. Considering that these loans had been decreasing for the previous 3 months, this sudden U-turn indicates a massive rush of retail investors leveraging their credit to enter the market right now.
So the volume is massive. The numbers do say, but borrowing money is always risky, you know, especially when the interest rates are not exactly low. What are the experts saying about this, the danger level?
Right, that's the crux of the problem. It's not just about the risk of the stock prices falling, it's the cost of holding these debt, right? So currently the interest rate for credit loans or margin trading is hovering around 8 to 10%. So individually, it's always a risk.
If you take out a loan at a high interest rate of 10% and the stock drops by 30%, you are essentially facing a total loss of 40%. Brokerages typically lend up to twice the amount of capital you hold. For this very reason, it is best to invest in stocks using your own available cash flow.
Now, this is only for Korean stocks, right? There is a limit to how much a stock can fall in a day in Korean stocks, the 30% mentioned. For markets like the U.S., there is no limit to how much a stock can fall on a daily basis.
You know, that is a very sobering calculation. A 40% potential hit is significant. But looking at the bigger picture, Do-yeon, if this B2 trend continues, does it pose any systematic risk to the Korean economy?
Now, that is the question on the minds of the policymakers right now in terms of financial services. While individual bankruptcy is tragic, the fear is that a mass wave of defaults could rock the financial system. Now, according to recently released credit level data by the Bank of Korea for the third quarter, it's at an all-time high. Adding a layer of volatile, high-interest private debt on top of that fragile structure is dangerous. If the market crashes, these borrowers default, banks take a hit, and domestic consumption freezes because of households are paying off debt instead of spending. However, the Financial Services Commission is trying to walk a fine line. Their official stance up until last week was that the situation is manageable. They point out that while October saw a spike, if you look at the year-to-date figures, total credit loans across the financial sector have actually decreased by 2.0 trillion won in 2025. So they don't view this as a total system failure yet, but this week, the FSC has also switched its monitoring system for margin lending to a daily basis. They're now checking the loan balances and collateral ratios of security firms every single day, rather than monthly or weekly. They've also issued strict warnings to brokerages to manage their credit limits conservatively. Now, essentially, the government is saying we don't stop you from investing, but if you borrow beyond your means, we can't save you.
You know, a huge message to keep in mind when investing and from borrowing.
Right, with your cash now.
Right.
Yeah.
All right, Do-yeon, thanks for the comprehensive coverage.
Thanks for having me.